Hello, my name is Sushant and I will be teaching you for this demo lecture. My qualification, I am CFA, I am FRM, I am CMA US. Also I've done my Masters in Finance. Also I've done a few certification like CCRAN and CIRA. So let's talk about derivative. Derivative is a financial instrument that its value depends on the performance of the underlying asset. Underlying asset could be stock, it could be commodity, it could be bond. That is, I make a contract today and its obligation will be due in the future. So there are two parties to the contract, the buyer who is the long and there is a seller who is the short, and it is traded in two market. That is, it can be traded on the exchange or it can be traded on the OTC market, which is also known as the dealer market. OTC market or over the counter market is customized, that is, the contract can be changed as per the customer's needs and it is less lightly regulated version. On the other hand, the exchange is highly centralized and it is highly regulated. So forward contracts, let's say there's one person farmer, he is short, that is he want to sell something. Let's say he enter into contract to sell wheat at a price of 50 per kg with Mr. Red, who is the buyer or also known as the long. So there's one party seller, the short, and there is the second party, the buyer, which is the long. So they both enter into a contract at time zero. So buyer will buy wheat from the farmer at a price of 50 per kg after 3 months, and the seller, the farmer, will sell at a price of 50 per kg. So both parties have fixed a price. After the end of certain time period, that is after 3 months, they will buy or sell. The buyer will buy. So both has the obligation. Buyer has the obligation to buy and the seller has the obligation to sell. If they fail to do so, there will be legal proceeding. And this 50 is known as exercise price. So forward contract is a commitment that each party agrees that they will fulfill at a future date. If they fail to do so, there will be legal proceeding to enforce performance. Along the buyer is hoping that the price will increase and the seller is hoping that the price will decrease. Now let's talk about the call option. Again, it is the sub part of the segment derivatives. Call option gives the holders, let's say Mr. Green has a right to buy an underlying asset. So he does not have the obligation to buy. He has a right to buy. So let's say at a fixed price over a period of time. Let's say Mr. Green entered into a contract with this Mr. White, who is holding the share of HP Hewlett Packard. Mr. White, on the other hand, has an obligation to sell. So he is short here. One party, Mr. Green, has the right to buy, and the second party has the obligation to sell. So at time zero, they enter into a contract. To enter into a contract, since Mr. Green has the right to buy, so if the price is good, he will buy. The price is not good, he will not buy. So let's say they fix a price of 100 by paying this $4 known as the option premium. So by paying this $4, Mr. Green get the right to buy at a fixed price of 100 after 3 months. So he get the right to buy at a price of 100. If the price is above 100, if let's say the share of HP is 130, 110, 140, of course he will buy it. And if let's say the price is 60, 70, 80, he will not buy it because he has to pay 100 to buy it. Mr. White, he actually received a premium of $4 for his obligation to sell, since he is taking the obligation. So one party has the right, that is Mr. Green here, and one party has the obligation, that is Mr. White here. This $4 is known as option premium, and this $100 is known as the exercise price. So if the price is 100, the profit is 16, not 20, because 4 he has already paid. So the price is 120, he only has to pay 100, payoff is 20, out of which 4 goes to the option premium that he has paid already in the starting. So his net profit is 16. Contrary, if the price, let's say, is 70, then he don't have to buy it. So the loss will not be 34 or 26. Rather, it will only be $4. And the break-even price, the price at which both the parties, so that is they are having a profit of 0. That is 104, because if Mr. Green decide to buy this at a price of 104, he only has to pay 100. So the payoff is 4, and from that if we subtract the premium of $4, we get the profit equal to 0. So this point is known as my break-even price. Now let's move forward. So if we see, this was option premium and this $100 was the exercise price. Let's say if you decide to buy this at a price of 130 after maybe 1 month or maybe after 2 months, you can do so. But if your option is American, so option can be further categorized into American and European. So if your option is American, then you can buy it. But if your option is European, then it can only be used at the expiry. That is, after the end of 3 months, you can decide whether to buy it or not. So if the price goes up in the middle, then American is more valuable to you, because you can buy it in the middle, maybe here, or maybe here. There is no fixed rate. So anytime you can buy it. But European, you have to wait at the expiry date. If the price is 140 here, 130 here, you will buy it. If the price is 70 here, 90 here, you will not buy it. Because if something is at a price of 90 or 80, why would I pay 100 for that? That's why I will not buy it. Again, now here, I am telling you about the legal proceeding. So Mr. Green, he cannot default. So if the things are not in his favor, he will not use it. He will not use the option beyond the payment of the premium. Okay. And Mr. White, let's say Mr. Green decide to use the option. Let's say price become 250. In that scenario, Mr. White has to sell. And if he fail to do so, there will be legal proceeding. So only the short or the seller can default, which will happen if the long decide to use the option and the short fail to deliver. Now let's talk about plain vanilla swap. Plain vanilla swap, there's a one company known as Netflix. He is supposed to pay variable interest rate to the bank. Now this company expect the rate to rise, so he has to pay high amount of interest because his interest rate is variable. So what he does is he decide to make a contract with Mr. Red, known as swap dealer, in which he will pay a fixed amount since Netflix is expecting the rate to rise, and and for that he will receive the variable for a certain amount of principal. So they decided some notional principal. On that notional principal, Netflix will pay fixed. Let's say they are paying 5%, and for that they are receiving maybe variable rate. And let's say if the variable rate is very high, if it's 7, 8, 9, then he will get a lot of amount of money, and he does not have to worry about the changes in interest rate. Contrary, Mr. Red, who has entered into contract, he believes that rate will be lesser. That is, rate will be 2, 3. That is, he will receive 5% from Netflix, and he only has to pay, since he is paying the floating payment, he only has to pay 2, 3, 4%. So paying variable, expect rate to fall, that is swap dealer, and the company Netflix, they're paying fixed and receiving variable, so they expect rate to rise. Okay, let's talk about CDS. Let's say there's one company, Kingfisher, and there is one person who has given loan to Kingfisher, and Kingfisher company is paying principal and interest payment. So there's one party, CDS buyer, he is getting principal and interest from Kingfisher, but he thinks that the company might become bankrupt. So what he does is, he decide to enter into a CDS agreement with Mr. Red. For that, to enter into contract, he pay premium to CDS seller, that is Mr. Red, and Mr. Red will pay to Mr. Blue if the company default. So if the company default, that is, if Kingfisher become bankrupt, in that scenario, Mr. Red will pay the entire balance of the principal. So Mr. Red, in a way, it's kind of like providing the insurance. He is very sure that Kingfisher company will not become bankrupt, or it will not default on the loan. Contrary, Mr. Blue is trying to hedge the risk he is facing regarding the loan. That is, if Kingfisher default, he does not bear the loss. For that, he has taken a CDS, which is a kind of insurance to him. Now, let's talk about short selling. Let's say Mr. Green, he is bearish on the market. When I use the word bearish, I mean that he expects stock to, okay, so what he does is, he enter into contract with the broker, in which, let's say Mr. Red is the broker or security lender. So what he does is, he borrows security from him and sell it. Let's say the price right now, let's say, is 10153. So he borrows security from Mr. Red and sell it at this price, and then he will buy when the price falls. So if he is right in his estimation, the price right now is 10153, and if it's right in his estimation that the things will not go smooth, the price will fall, in that scenario, he will sell here and he will buy here. And if he's right, he will make a gain. Of course, if his estimation is wrong, then he will suffer loss as well. Of course, to enter into this, the security lender or Mr. Red will ask for a interest for that. And after the, let's say, after the expiry of maybe 1 month, he want his security back. So he sell at 1053 and he buy at 9788. Of course, when you're selling high and you're buying at a cheaper price, of course, you will make a profit. And the profit is 365. That's it. Hope you enjoyed the demo. Thank you so much.